Home prices in your mountain town might be falling right now, but your insurance bill, your property taxes, and your HOA fees are quietly exploding. What looks like a buying opportunity on paper is, for many homeowners, turning into a financial trap they can't escape. Houses are cheaper, yet owning one has never been more expensive. And in some towns, selling isn't even an option anymore. Across the United States, once booming mountain markets are freezing solid. Inventory is piling up. Buyers are disappearing, and the people who rushed in during the pandemic are now desperately looking for a way out. So the real question is this: which American mountain towns are quietly draining wealth from homeowners, even as prices fall? The collapse unfolding in America's mountain town is not happening in isolation. It is the result of several powerful forces reversing direction at the same time, and doing so faster than most homeowners expected. First, interest rates changed the rules of the game. For years, cheap money masked risk. Buyers stretched budgets, investors leveraged aggressively, and prices climbed far beyond what local incomes could support. Once mortgage rates surged, demand didn't slow gradually. It disappeared. In high-priced, non-essential markets like mountain towns, buyers simply stepped away. Second, the remote work migration that fueled these booms has begun to unwind. During the pandemic, workers fled dense cities for lifestyle destinations, believing flexibility was permanent. That assumption is now breaking. Return-to-office mandates, layoffs in tech and finance, and shrinking stock portfolios have forced many of these households to reconsider expensive second homes and remote primary residences. In several former Zoom towns, outbound migration is now exceeding inbound movement for the first time in a decade. Third, investors are pulling back, hard. Short-term rental regulations have tightened across many resort communities. Caps, bans, and licensing limits have eliminated the cash flow models that justified peak-era prices. At the same time, rising vacancy rates and weaker tourism demand have crushed occupancy assumptions. Properties once marketed as self-funding are now bleeding cash every month. Fourth, the cost of ownership itself has quietly become the most dangerous variable. Property taxes have reset higher after peak valuations. HOA dues and resort fees have surged with inflation. And in wildfire-exposed regions, insurance premiums have doubled or tripled, or vanished altogether as carriers exit entire zip codes. In this environment, even a discounted home can become unaffordable to hold. What makes this correction different from previous cycles is not just falling prices. It is the disappearance of growth drivers. There is no wave of new buyers waiting in the wings. No demographic surge poised to absorb excess inventory. No policy lever that instantly restores affordability or confidence. Instead, these markets are facing a structural reset. Inventory is rising while liquidity evaporates. Sellers are chasing prices downward. Buyers are waiting. And time itself is becoming the enemy, as months on market stretch longer and carrying costs compound. Before we examine the 7 towns where this stress is most visible, take a moment to like the video, subscribe to the channel, and turn on notifications. Each of the next 7 stories is real, data-driven, and unfolding right now. 1. Bend. Bend was once held up as the ultimate pandemic success story. Nestled in Central Oregon, it became a symbol of the remote work revolution. Outdoor lifestyle, tech salaries, and an endless stream of new arrivals fleeing West Coast metros. For a time, it worked. Prices surged. Inventory vanished. Homes sold in days. That era is now ending. Recent migration data shows something Bend had not experienced in over a decade. More people are leaving than arriving. A net migration loss may sound small on paper, but in a market built entirely on inbound demand, it is devastating. Almost overnight, listings began to stack up. Inventory has climbed to a 10-year high, and homes that once sparked bidding wars now sit untouched. Prices are already responding. After peaking near historic highs, median home values have dropped sharply, with a notable decline concentrated in just the last quarter. That speed matters. Fast declines change psychology. Buyers stop rushing. Sellers panic, deals stall. The pressure is magnified by Bend's exposure to the tech sector. Many of the remote workers who inflated this market were tied to West Coast technology firms. As layoffs spread and stock compensation shrank, confidence evaporated. Jumbo loan defaults have begun to rise, an early warning sign that overstretched buyers are losing their footing. Meanwhile, Bend's local economy cannot absorb these prices. Wages never caught up to valuations, and now there is no external buyer pool left to bridge the gap. Commercial real estate is also showing strain, with downtown vacancies creeping higher as discretionary spending slows. What makes Bend particularly fragile is that nothing is replacing the demand that just left. Remote work is no longer expanding, investors are no longer optimistic, and locals were priced out long ago. So the question becomes unavoidable. If a market built entirely on migration starts losing people, who is left to buy? 2. Breckenridge. Breckenridge did not collapse because demand vanished overnight. It collapsed because the rules changed, suddenly and permanently. For years, this Colorado ski town thrived on a simple equation: high nightly rates, near constant tourist demand, and short-term rentals that covered mortgages with room to spare. Investors piled in. Condos and townhomes were priced not as shelter, but as income machines. Then regulation arrived. Local authorities imposed strict caps and limitations on short-term rentals, effectively dismantling the cash flow model that justified peak prices. Almost immediately, investment properties lost their economic logic. Sales volume for condos and townhomes, previously the backbone of the market, fell sharply. Inventory surged well above historical norms as owners rushed to exit before losses deepened. But selling was no longer easy. Listings began to linger. A majority of properties now sit on the market far longer than they did during the boom. Prices have already taken a visible hit, with median values dropping by hundreds of thousands of dollars from their peak. For sellers who bought near the top, this is not a paper loss, it is a permanent reset. At the same time, ownership costs moved in the opposite direction. Property tax assessments jumped after years of appreciation, raising annual expenses even as values fell. HOA fees and maintenance costs climbed with inflation. And despite fewer legal short-term rentals, occupancy rates for the remaining units declined, signaling softer tourism demand. The result is a classic squeeze. Owners can no longer rent freely, they cannot sell quickly, and holding the property grows more expensive each month. Breckenridge illustrates a hard truth many investors ignored. When a market depends on policy permission to function, that market is fragile by design. So the next question is unavoidable. What happens when regulation pulls the plug on an entire investment strategy and everyone heads for the exit at once? 3. South Lake Tahoe. South Lake Tahoe is not just cooling down. It is being hollowed out by forces that have nothing to do with asking prices. For years, this market relied on two pillars: vacation rentals and the belief that natural beauty guaranteed endless demand. Both assumptions are now breaking at the same time. Active listings have surged dramatically while closed sales have collapsed. Homes are sitting longer, price cuts are spreading, and confidence is eroding. But the real shock is coming from the cost side. Wildfire risk has transformed insurance from a line item into a deal breaker. In many cases, annual premiums have climbed into five-figure territory for modest cabins. Some owners are discovering that coverage is no longer available at any price. A house that cannot be insured cannot be financed, and a house that cannot be financed is nearly impossible to sell. Regulation has delivered a second blow. Bans and restrictions on vacation rentals in residential areas have stripped away the primary income stream investors relied on. Properties once marketed as cash flow positive now generate nothing while expenses continue to rise. The result is a market full of sellers who must exit and buyers who refuse to step in. Price reductions tell the story. A majority of active listings have already cut their asking prices, often repeatedly, yet transactions remain scarce. Foreclosure filings are beginning to appear, a signal that stress is moving from theory to reality. South Lake Tahoe exposes a dangerous illusion, that lifestyle markets are immune to fundamentals. When insurance disappears, regulation tightens, and discretionary travel slows, beauty does not protect your balance sheet. The market here is not finding a floor, it is searching for permission to function at all. Which raises the next question. If a home becomes uninsurable and unrentable, what is it really worth? 4. Park City. Park City is where excess goes to stall. This market is not collapsing because buyers vanished entirely. It is collapsing because there are too many expensive homes and too few willing bidders. During the boom, luxury construction surged. Developers assumed high net worth demand would remain endless. It did not. Today, the upper end of Park City's market is drowning in supply. Homes priced in the multi-million-dollar range now face well over a year of inventory, a clear signal of a liquidity crisis. Even if no new listings appeared tomorrow, it would take many months to clear what already exists. Time on market has stretched dramatically. Properties that once sold quietly off-market now linger for an entire season or longer. Sellers respond the only way they can, by cutting prices. Reductions in the hundreds of thousands of dollars are no longer shocking, they are routine. And yet buyers remain patient, waiting for deeper capitulation. Ownership costs are amplifying the pressure. HOA dues and resort fees have climbed sharply, driven by inflation and higher operating expenses. Carrying a luxury home now means paying escalating fixed costs while watching market value slide. For investors, the math is unforgiving. For owner-occupants, the psychological toll is heavy. What makes Park City especially revealing is who is stepping back. This is not a market dependent on first-time buyers. These are affluent households choosing not to deploy capital. When wealthy buyers decide to sit on cash instead of purchasing trophy properties, it sends a clear signal about expectations. Park City demonstrates a critical lesson. Luxury does not equal liquidity. High prices, prestige, and exclusivity offer no protection when confidence disappears. Which leads directly to the next question. If even the wealthiest buyers are waiting, who is left to absorb the excess? 5. Coeur d'Alene. Coeur d'Alene was one of the most overheated markets in the country just 2 years ago. Demand poured in from out of state, prices surged at record speed, and the prevailing belief was simple. The migration would never stop. It stopped. What followed was not a gentle slowdown, but a sharp reversal. Inventory has climbed back to levels not seen since the aftermath of the last housing crash. Listings are no longer scarce, and sellers are now competing against each other rather than buyers. Price reductions are becoming routine, not exceptional. The core problem here is structural. Local wages never supported peak valuations, and once the external flow of buyers dried up, there was nothing underneath to hold prices in place. Homes built for newcomers now sit empty or discounted, waiting for demand that no longer exists. Builders are among the most exposed. New housing starts have dropped sharply as unsold spec homes pile up. Construction slowed not because confidence weakened, but because inventory could no longer move. When builders stop building, it signals that the market is no longer functioning normally. The rental market is also softening. Rents have begun to decline year over year, removing the fallback option for owners who hoped to rent until prices recovered. That strategy is failing. Carrying costs remain high while income expectations fall. What makes Coeur d'Alene particularly dangerous is the speed of the shift. This market did not drift lower over many years. It turned abruptly, catching late buyers and investors off guard. Many are now chasing the market downward, cutting prices repeatedly just to attract attention. Coeur d'Alene serves as a warning. Migration-driven booms are fragile. When demand is imported rather than organic, it can vanish just as quickly as it arrived. So the question becomes clear. How many other markets were built on demand that was never meant to last? 6. Truckee. Truckee sits at the edge of Lake Tahoe, and for years it thrived almost entirely on discretionary wealth. This was a second home market powered by Bay Area tech money, stock market gains, and the belief that lifestyle properties were a safe place to park capital. That belief has cracked. Transaction volume has fallen sharply from its peak, a sign that buyers are no longer willing or able to commit at previous price levels. Inventory has surged most aggressively in the $1 million range, precisely where second home demand once dominated. Sellers are no longer competing on finishes or views. They are competing simply to be noticed. What makes Truckee especially fragile is the collapse of deal confidence. A growing share of purchase contracts are falling apart before closing. Buyers walk away late in the process, either because financing terms change, insurance costs shock them, or broader financial uncertainty makes the risk feel unjustifiable. Each canceled deal reinforces caution in the next buyer. The insurance situation compounds the problem. Premiums in wildfire-exposed areas have jumped dramatically, adding thousands of dollars per year in carrying costs. For second homeowners who visit occasionally, these expenses offer no practical return. The house becomes a liability rather than a retreat. Price behavior reflects this stress. Homes are routinely selling below asking, and days on market continue to climb. Sellers who once expected quick exits now face a slow, grinding process with no clear floor in sight. Truckee reveals a critical truth about discretionary markets. When confidence disappears, liquidity evaporates first. These buyers do not need to buy. When uncertainty rises, they simply wait. And that leads directly to the final question before our last stop. If the wealthiest second home buyers step back, what happens to a market built almost entirely for them? 7. Bozeman. Bozeman is the epicenter of the mountain town collapse. This was the market where the bubble inflated the fastest, and where the consequences are now the most severe. During the pandemic, Bozeman earned the nickname Los Angeles. Prices surged to levels that bore no relationship to local wages. Single-family homes approached luxury market territory, even as the local workforce struggled to remain housed. The assumption was that demand from outside the region would always fill the gap. That assumption failed. Inventory has exploded in a remarkably short period of time. Listings have multiplied, while closed sales have fallen sharply. Homes that once attracted bidding wars now sit empty, forcing sellers into repeated price cuts. The market is no longer discovering prices upward, it is chasing them downward. Affordability has collapsed. By standard metrics, Bozeman now ranks among the least affordable housing markets in the country relative to income. Locals cannot buy, and outsiders have lost interest. This is the worst possible combination for liquidity. Builders are feeling the strain first. New subdivisions are partially occupied or entirely empty. Incentives once reserved for slow markets, large credits, upgrades, and cash offers, are now common, yet absorption remains weak. When builders offer concessions and still cannot sell, it signals that demand is fundamentally broken. Financial stress is beginning to surface. Foreclosure activity is rising, and rental vacancies are climbing as speculative demand unwinds. Properties purchased at peak prices are now worth less, sometimes significantly less, than their outstanding mortgages. Bozeman represents the final stage of a familiar cycle. Rapid appreciation fueled by external demand, followed by a sharp reset when that demand disappears. There is no quick fix here. Restoring balance will require years, not months. Which brings us to the unavoidable question. If this is the outcome of the pandemic boom, how many other safe markets are heading toward the same reckoning? Taken together, these 7 markets tell a single story, one that repeats with unsettling consistency. Prices did not rise because fundamentals improved. They rose because money was cheap, fear of missing out was widespread, and demand was imported rather than earned. When those conditions reversed, the illusion collapsed. Across these mountain towns, the pattern is clear. Inventory surged faster than demand could absorb it. Buyers gained leverage and then withdrew entirely. Carrying insurance, taxes, HOA dues continued to rise even as values fell. And the belief that you can always rent it out proved fragile once regulations tightened and tourism softened. This is why the current downturn feels different. In past cycles, falling prices eventually attracted buyers back into the market. Today, affordability is not the only obstacle. Confidence is broken. Liquidity is scarce. And many properties are no longer financially viable to hold, even at lower valuations. The deeper lesson is not about any single town. It is about risk concentration. When markets depend on one buyer type, one income source, or one policy environment, they become brittle. When conditions change, they do not bend, they fracture. For homeowners, the warning is sobering. A declining price is only one part of the equation. If costs keep rising and exit options vanish, a house can quietly turn from an asset into a liability. For investors, the takeaway is even sharper. Leverage magnifies not just gains but mistakes. The question now is not whether this is happening. It is how far it spreads and how long the reset lasts. Are these mountain towns simply early examples of a broader correction or the extreme edge of a cycle that will stop here? If you found this analysis valuable, like the video, subscribe to the channel, and turn on notifications so you don't miss the next investigation. And if you live in or invest in one of these markets, share your experience in the comments below. Your story may help others avoid the same traps. The data is changing, the risks are real, and the next chapter of this housing cycle is already being written.